In today's episode, we continue to open up the mailbag and pull out questions focused on taxes and year-end planning. We're going to give responses to questions about whether you should be saving into a different account than the 401k. A question in regards to if you're getting a lump sum at the end of the year, but have the option to stretch it over the next year, what you should do. And then the last question is in regards to charitable giving and how you can deduct that from your taxes. Stick around. We've got great questions, and we'll talk about strategies and opportunities to help keep more in your pocket and your retirement accounts versus give it to the IRS.
Welcome to the Your Life, Your Money podcast with Scott Searns, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of The Retirement Show, all about your life, your money, and today we're going to continue to talk about your taxes. I'm your host, Scott Searns. My goal is to help you thrive in life, wealth, and retirement. And as I mentioned, today we're going to continue to talk about taxes. This is our third and final week of answering questions from the tax mailbag, but as you know me, I love to talk about taxes, love to talk about ways to help you keep more of your hard-earned retirement savings in your retirement accounts versus giving them to the IRS. So definitely not the final week talking about taxes, but the final week for this month answering questions from the mailbag, but specifically around year-end planning and around tax strategies. You know, at the beginning of the month, we talked about strategy, we talked about theory, we talked about how to see and understand opportunity in your situation. And all of those are really helpful things, you know, the strategies, the theories, but a lot of that creates ideas. And ideas are great, but ideas can be a dime a dozen unless action is taken. Action on ideas, that's what helps you save money. That's what helps you make more money. That's what helps you keep more of your hard-earned retirement savings in your account versus giving it to the IRS. That's the main reason with all of our clients we do our September, October meetings, all focused on year-end planning and tax strategies. So not only are we talking about the theory, the strategies, the opportunities, but we have an action item list that we're walking away from that meeting with to actually implement the ideas to help people save money when it comes to taxes, to help people improve their overall net worth. Think about this. Elon Musk had a great idea, right, with like a fully electric car, but nothing would have happened. He could have just had this great idea, but the reason that Teslas are driving down the road is because he took action. Even myself, I had a great idea to help people with their financial futures, help people with their retirement plans, help people maximize their retirement story. It could have been a great idea, but I took action. I started a company. We help our clients in the strategy meetings take action each and every year. We help our clients in their year-end planning tax strategy meetings take action each and every year. Took this idea to help people out, but actually took action on it, started the business, and helping people with what I wanted to do. So hopefully that just kind of gives you some thoughts here, because as we dive into this mailbag and we answer some of these questions, we go through some of the responses, I want you to think about your situation. I want you to think about where you're at today. What did you hear from us here in the podcast at the beginning of the month? All the different ideas that were out there. And now I want you to apply them to your situation. I want you to apply and take action, because a lot of these strategies you have to utilize, you have to put into place before the end of the year. Okay, enough on that. I think you got the point. Ideas are great, but it's action that will help you keep more of your hard-earned money with you. We've got some great questions today. Questions about where to be saving your money. Questions in regards to, let's just say, an unexpected payment at the end of the year, but could potentially be delayed to the next year. What's the best thing to do? This one is for someone that's retiring but getting paid out a lump sum of unused vacation pay. The third question comes in from Janet, and hers is wrapped around giving to charitable organizations. They once got a deduction for that. They're no longer getting a deduction. Is there anything that they can do? So So as I mentioned, some great questions, and I believe that you'll be able to take strategies, thoughts, actions away from these questions today to potentially implement them in your own scenario. All right, so here we go. We're going to start with Tim's question. Tim says, I'm 56 years old. I don't plan to retire until 70. My wife and I have always saved into our 401ks. All of our money right now is in our 401ks, and we have just a little bit in our savings account. After listening to your show, I'm starting to understand the impact that required minimum distributions may have on our future. Should we be saving somewhere else? Okay, so Tim here and his spouse have sounds like they're saving. That's a great point. That's a first great action. You're saving money. Great job, Tim. You're getting prepared for your future and for your retirement. Tim and his wife here are saving all of their money into their 401ks. And as he's heard me talk about those required minimum distributions, so 401ks, in your 70s, you're going to be forced to take that money out. When you're forced to take that money out, you're going to pay tax on every dollar that you take out. So he's thinking, okay, wait a second, could that put me into a higher tax bracket in my future? Should I be saving somewhere else? Maybe not into my 401k. Should I be utilizing some other tax account to be saving into? And this is a great one wrapped around tax diversification. And you've probably just heard in general the word diversification, but let me just give you a quick analogy of why diversification is so important. Let's just say Home Depot, and I don't even know if they sell these, but let's just say Home Depot only sold sandbags. That was it. If you walked into Home Depot, you looked around, what did you see? Sandbags. That's it. Nothing else. Well, if there's flooding all the time, Home Depot is in the best business ever because they sell sandbags. People need sandbags. Home Depot is going to see record profits. However, what if the whole country goes into a 10-year drought and all Home Depot sold was sandbags? They're not selling any sandbags. You see, they didn't diversify themselves because all they sold was sandbags. And if they go into a 10-year drought, guess what? Next thing you know, the U.S. goes into a 10-year drought. Next thing you know, Home Depot could potentially go out of business because all they sold was sandbags. They put all of their eggs into one basket. And that's, of course, not the case. And now as you walk through Home Depot and you see all these different tools and equipment and everything on the walls and the shelves, that's why, because they diversify themselves when it comes to a construction equipment and home supply store. And the same holds true when it comes to your taxes, is you want to diversify yourself, not necessarily have all of your eggs in one basket. And when it comes to your taxes, you right now, Tim, right? But Tim, I'm guessing you're not alone in this. People are listening going, yeah, wait a second. I'm saving all of my money into my 401k too. Should I make changes? Should I do something different? Well, first off, let's just talk about the 401k. The 401k, you get that tax deduction today. You're going to pay taxes later. So right now, you're kind of like if Home Depot would only sell sandbags. You're putting all of your money into one tax account. And I tell you what, taxes go down in the future. They drop dramatically. Guess what? You pick the right tax account because you got the tax deduction today. Taxes go down in the future. You're taking money out. You won the game because you've put it away today. When it comes out in the future, you're paying a lower tax rate. However, you have to ask yourself, do you think taxes are going down in the future? And maybe in your situation they are. Maybe you're in the 30% tax bracket today, you're making great money, and for you, tax rates might be lower in the future. Maybe you're kind of making the average American income, and if all of your money's in your 401k, and next thing you know, you've saved up $500,000, $1 million, $2 million, $3 million or more into that 401k, and that's your only account, that's your only tax account for your future, the only place you have to pull money from, and that bucket's going to get taxed, well, what if your tax bracket, your tax rates are actually up in the future? What if Congress changes the laws and raise tax rates in the future because of all of the debt that we have in the United States right now. Now all of a sudden you might be in trouble. Kind of like if Home Depot only sold sandbags, right? And we went into a 10-year drought. That's a problem. And then the other thing that you really need to think about, Tim, is, and I'm just making this up, but what if in your future, in retirement, you're like, you know what? Hey, let's buy an RV, and we need a big lump sum of money out of our 401k to buy that RV. Well, let's just say you're at the top of the 12% bracket, and you're going to spend $100,000 on this RV. Next thing you know, that's going to push you right up into the 22% bracket. That money is going to, that lump sum that you need, because it's all going to get taxed, is going to push you into another bracket. Maybe you're at the top of the 24% bracket. Now you're taking out another $100,000. Next thing you know, it pushes you up into the 30+% tax bracket on that money that you need to take out. So these are all reasons why I really feel like it's important to add diversification to your savings. And the IRS, as I mentioned at the beginning of the month, looks at your money in 3 different buckets. The bucket that we've been talking about so far here, Tim, is your tax-deferred bucket. That's where you've deferred your taxes. When you put money into your 401k, you took a tax deduction and you're deferring those taxes to the future. One bucket to have money in. Now, another bucket that you could have money in would be the taxable bucket. The taxable bucket, let me give you some examples that sit in the taxable bucket. That would be saving into like a savings account, a CD, a money market account. The other thing that could be here would be a brokerage account. Sometimes those would be called like an individual account, a trust account, or a joint account. You can do all the same things. You can invest money in these types of accounts. It's just in a non-retirement account. So where you're going to pay income taxes on every dollar that comes out of your 401k, and these taxable accounts, now you're only paying on dividends, interest, and gains. You're paying on dividends, interest, and gains. So you're just paying on those portions right there. The other thing to potentially shift some of your savings to, and this depends on where you think that you'll be in the future versus today, but the other thing to look at is the Roth 401k, where you would pay tax today, but then the money grows tax-free and you've got withdrawals tax-free in the future. So now let's just say that same RV story, you need a $100,000 lump sum. Well, maybe it takes some from your 401k. It gets you up to the top of the 12% bracket, but then you go to your Roth 401k, the tax-free money, and you take out the rest. So that way it's not pushing you up into another tax bracket as you're taking the money out. So hopefully you're seeing here all of the different thoughts and reasons why I think it's really important to include tax diversification in your overall retirement plan. Tim, this is a great question. I'm glad that you're thinking about it in your mid-50s. A lot of times people get into their 60s or they're a year away from retirement, and all they've done is just saved into their 401k for their entire life. And so then it's more of a management of how to take money out and try to reduce the taxes on those withdrawals as much as possible. So great question here, Tim. Great job on asking the question, save into some different things. One thing that I just want to add here as you think about, okay, hey, here's these other types of buckets that I can save into. It could really help you to do a tax projection of your future, understanding where you're at from an income standpoint today, but then what kind of income could you have coming in your future, meaning the Social Securities, pensions, required minimum distributions, rental income, anything that you'll have coming in, and where does that compare to today? So, if you've got $150,000, taxable income today, are there points in life where you might have less than that? What about in the future? Now that you've saved all this money into your 401ks, in your 70s, are you going to have $150,000 coming in? Is it going to be $200,000? Where's that at based on those required minimum distributions? That's really going to help you understand if you should be switching over to the Roth 401k or if you should just be putting money into that brokerage account. But just doing different things can definitely help you out, no matter which way. Just like my analogy, if Home Depot only sold sandbags, right? Years of floods, hey, they're going to do great. Years of drought, they're going to be in trouble. Well, same thing for you. If you diversify, instead of just having sandbags, instead of just having the 401k, if you diversify, you've got the brokerage account, the Roth account, taxes go up in the future, guess what? Maybe you take and start pulling some money from your Roth. Taxes go down in the future, great time to pull from your 401k. You've now got that added ability to switch things around no matter which way the IRS pushes the tax brackets and tax rates in the future. Great question, Tim. Hopefully that helps you out. Don't forget, take action. So think about what you need to do and just start something different if that's what you need to do. Okay, our next question here is from Rebecca. Rebecca says, I'm retiring towards the end of the year. Exact date still to be determined. And amazingly, I'll have about 16 weeks of unused vacation and sick leave that they'll pay me. Wow, nice job. I'm told that I can take all of this in my final paycheck or continue being paid my normal schedule every 2 weeks for a few months after I retire. Does it matter which way I do it? Rebecca, I love the question. It really says that you're thinking about this or potentially thinking about this strategically, because I know for a lot of people, if their company said, hey, we can pay you out 16 weeks of vacation, and they saw the dollar amount on that check, they'd say, gimme, 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 right? Like, that looks awesome. Hand it over, put it into my account. But Rebecca, I'm really going to tell you here to think about delayed gratification. Delayed gratification. And just for everybody that's listening to this that might have a similar scenario or might have this ability to get a payout before the end of the year or the ability to take some income before the end of the year or push it off into the next year, hopefully here, kind of listen through this. I want to help you understand why that delayed gratification might be in Rebecca's best interest. Delayed gratification meaning taking those payouts over the next 16 weeks, trying to stretch those into the next year. Okay, let's just say, here's the example of why. Let's just say Rebecca is single. She's making $100,000 a year. So at $100,000 of taxable income, let's say after deductions, etc., that puts Rebecca in the 22% tax bracket. Now, Rebecca takes a 16-week payout. Let's just say 16 weeks, did some math here, maybe it's around $30,000. If she were to take that this year, one big lump sum, puts her up to $130,000 of taxable income. After the standard deduction, guess what? Rebecca is now in the 24% tax bracket. 22% to 24%. That $30,000 more, right? She's paying 2% more in taxes on that really nice payout. Instead, what if Rebecca retires? What if she had big savings to live off of? You know, she did tax diversifications. She had money in her savings account, brokerage account, other accounts other than her 401k and IRA that she could live off of and basically keep her taxable income to zero. And now she says, yep, delayed gratification, I'm going to stretch those payments out through the next year. So now that $30,000, let's just say they pay it out, you know, starting January 1st through the first 16 weeks of the following year. Well, now that $30,000, guess what? It's in the following year. All that taxable income comes in the following year, where she's basically already at zero taxable income because she doesn't have her $100,000 wage income coming in from her company anymore. Now guess which bracket she's in? She's in the 12% bracket. What a savings just by thinking through this. What a savings just by potentially, you know, again, I'm making up that Rebecca had tax diversification, but back to Tim's question, let's just say Rebecca had tax diversification. She had other monies to live off of. She's going to get this nice big payout. She got her income basically down to zero. So this $30,000 is almost like the only taxable income that she's got coming in. She gets it at a reduced tax rate. So Becca, hopefully you're listening in. You can look at your overall situation. but delayed gratification might really help you out here, pushing those payouts off into the next year. And anybody thinking about that, just like Rebecca, hopefully it makes you think a little bit differently when you see the nice dollar sign on that lump sum check that you could get. Would it help you to stretch it over the following year? Are you going to be in a lower tax bracket next year than where you're at this year? Okay, we've got one more question that came in from Janet. This one's all about charitable giving, and it's just a good question. I think a lot of people run into this, and so we'll see if we can potentially help Janet and her husband out here. So here we go. From Janet, she says, my husband and I give around $10,000 a year to different charitable organizations. While our primary focus is being helpful to the charity, we also used to be able to deduct this on our taxes. So they're given $10,000 a year. Primary focus helped the charity, but they were able to get a tax deduction in the past, she's saying. Our tax preparer said we are no longer able to deduct these donations. Is that true? And is there any way to get a deduction again on our taxes? Well, a few things here, Janet. Yes, it is true that the standard deduction went up. So, for instance, if you're married filing jointly, the base standard deduction is $27,700 in 2023. As a single, the base standard deduction is $13,850. What does that mean? Well, all of your itemized deductions, for instance, the $10,000 to the charity, maybe you've got some mortgage deductions, property tax deductions, all of the itemized deductions would have to exceed that in your case, married filing jointly, would have to exceed the $27,700 for you to be able to deduct it. And so your tax preparer could totally be correct here, because if you add up your charitable gifts and then you add up the other potential deductions, if they're not exceeding the $27,700, well, then you're not currently deducting the charitable gifts on your taxes. But, and here's the part you've been waiting for, right? What if you could get the best of both worlds? What if you could get the best of giving to that charitable organization? Like I said, it's your primary focus, the helpful thing that you want to do, and be able to write that off on your taxes. And I'm going to give you a couple scenarios here of how we can potentially do this. So the first scenario here, qualified charitable distributions. Janet, if you and your husband are age 70 and a half or older, you have the ability to give directly from your IRA to the charitable organization. And you might be thinking, well, how does that help me out? Well, think about it this way. Right now, you're writing the check to that charitable organization from your checking account. How did that money get into your checking account? Whether it came as income, whether it was a withdrawal from your IRA, the money got taxed for it to go into your checking account. So you're taking money that already got taxed and then you're giving it to the charitable organization. What if instead you can give them money that has never been taxed? So basically for you, you're giving it to them tax-free. And that's what a qualified charitable distribution is. If you think about it, right now you're doing the process of, let's say, IRA to your checking account. When that money comes out, it gets taxed. Then you give to the charitable organization, and you don't have the ability to write that off because you're not surpassing the standard deduction. Instead, you give directly from your IRA to the charitable organization. So you're skipping your checking account directly from the IRA to the charitable organization. It's not coming out to your checking account, so guess what? You're giving them money that has never been taxed. Giving them money that's never been taxed. So you're giving them money that's basically tax-free. And that's a way for you to give them money and basically get the same thing of writing it off on your taxes. Just doesn't come out to your checking account. So that's strategy number one. And here's where the strategy really comes into play. Let's just say you had required minimum distributions that you needed to take this year of $75,000. Well, you gave $10,000 of that required minimum distribution directly from your IRA to the charitable organization. Now you only have $65,000 of actual taxable income. qualified charitable distributions can be a really, really huge process, or not a huge process, meaning like it takes a lot, but big process in the fact from a tax standpoint. Now, the other part here, number 2, so maybe Janet, you and your husband aren't age 70 and a half here, then the second thing that you could potentially consider is what we call a donor advised fund. I'm going to walk you through an example here. I'm going to try to keep it as simple as possible. And of course, anybody and everybody listening can substitute their own numbers into my example. All right, so let's just say, Janet, you and your husband, you also did tax diversification, and you've got $50,000 sitting in a brokerage account or in a savings account or in some account that you don't need immediate access to. So one of the things that you could do is you could put 5 years of your charitable contributions. You said $10,000 a year, so you could put $50,000. Now, does it have to be 5? No, it could be 6, it could be 7, it could be 4, it could be 2. As you can see, it can be whatever amount of years you want to put in there. It could also be whatever dollar amount, so it doesn't have to be $50,000. So, but just using your example here, you decided, okay, we're going to put 5 years times $10,000 a year into this donor advised fund. Now, that does not mean that you have to donate it all in 1 year. Just want to get that really clear off the plate. You have $50,000 now in this donor advised fund that you can contribute to charities throughout your lifetime. So you don't have to give it to them all in 1 year. You can do it over the next 5 years, or you can do it over your lifetime. Okay, so we take 5 times the $10,000 a year, you put $50,000 in. Well, guess what? That $50,000 now surpasses the standard deduction. So you get to deduct that $50,000 for that year that you did the donor advised fund, the year that you created it. And let me just explain to you the difference here. Let's just say for the next 5 years, you just kept giving the $10,000 a year. Well, guess what? You're just going to keep getting the standard deduction year after year after year. So if we take 5 times $27,700, over the next 5 years, you'll be deducting in total $138,500 from your taxes. But instead, if we did this donor advised fund where you took 5 years and put them all in at once, so now you've got year number 1 as a $50,000 deduction. Again, give that money over your lifetime, but year 1, because you put all of it in at once, you get the $50,000 deduction. And then over the next 4 years, you're just going to take the standard deduction. So $50,000 plus 4 years of the standard deduction at $27,700. Now your sum of overall deductions for 5 years is $160,800. So do nothing, the sum of deductions, $138,500. Do the donor advised fund, $160,800. Hopefully that helps you understand it. Try to keep it as simple as possible there. You can substitute in your own numbers, but that's a great way for Janet and her husband, if they've participated in tax diversification, have outside monies to be able to continue to give, for them to get a nice little deduction on their taxes for helping out in giving to a charity. So thanks for everything that you do and donating to charity. I'm sure it's for a great cause and super helpful. Hopefully we can also get you a tax deduction for all the great work that you're doing there. Folks, hope that you found these questions, the responses, everything to be of value and benefit. And if you're sitting there wondering, I wonder if Scott would be able to help me. I'm wondering if Scott would be able to help me and my spouse. Could he help us reduce our taxes, understand where to save to? Is it okay to retire? How much can we spend in retirement? The answer is yes. You see, each and every day we meet with families and individuals, people just like you, and it all starts with a 15-minute phone call. You can go to lifemoneyshow.com and click on the Work With Us tab to sign up for that phone call and learn about the total process. In that phone call, we're going to just learn about how you're hoping we can help you the most. And if we're a potential fit, we'll talk about all the next steps in the process. If not, we're going to make sure that we point you in the right direction. Again, lifemoneyshow.com, click on the Work With Us tab. Thanks for joining us today. Don't forget to subscribe on your favorite podcast player. And I look forward to our next show, helping you build wealth and being prepared for your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.